the Director General of the Indian Council of World Affairs, Ambassador Ganapathy, former Secretary, Ministry of External Affairs, Dr. Sivaraman, former Secretary, Ministry of Finance, Government of India, Mr. Somi Hazri, Secretary of the South India Chamber for Commerce and Industry, the distinguished faculty of the Indian Council of World Affairs, esteemed members of the Chennai Center for China Studies. At the outset, let me congratulate the C3S for organizing the one-day conference on China's economy, current status and prospects. I'm privileged to address the C3S for the second time. The subject assigned to me today is currency management and internationalization of the yuan. I'd like to thank the organizers for allowing me to address this conference through video conferencing. I do hope that my lecture and the discussions in this session will result in a deeper understanding of Chinese monetary policy matrix. To introduce the subject to the audience, let me present China's macroeconomic scenario as in 2018. In 2018, the momentum of the Chinese economy has remained strong. GDP growth has been in the range of 6.7 to 6.9%. Inflation has remained at 2% and unemployment rate has fallen. Corporate profits are being witnessed. Domestic and external conditions have remained favorable with reduced capital outflows and exchange rate pressures. China is also carrying US dollars 3.1 trillion of foreign exchange reserves. The strategy is to shift from high speed to high quality growth. The five-pronged approach for this is to rein in credit growth, accelerate the rebalancing efforts, increase the role of market forces, fostering openness, and modernizing the policy frameworks towards financial regulation. There has been a visible shift to the new economy with growth rebalancing towards the service sectors. Health and education have been opened to private investment, and land reforms have been undertaken to grant property rights to rural residents. There has been continued reduction in steel and coal capacities. Housing inventories have come down significantly with the social housing program. Monetary policy is one of the most important means through which China manages the economy. Its effect is transmitted to the financial system, the core of the modern economy. China's exchange rate has played a key role in achieving the macroeconomic objectives of price stability, growth, full employment, and a balanced BOP account. The RMB has been internationalized on a market-oriented basis and ranks fifth worldwide as a global currency of payment as of end August 2018, which amounts for 2.12% of the global market. RMB reserves held by countries stand at US dollars 194 billion, and over 60 foreign central banks and monetary authorities have included the RMB in their official foreign exchange reserves. China is focused on opening up the financial sector and has made headway in establishing a rules-based financial sector with the enactment of banking and insurance laws. One of the most important developments of recent years is the trade war. Amongst the most contentious issues that face the global economy is the trade war between the United States and China. The United States launched an investigation into Chinese trade policies in 2017. It imposed tariffs of billions of dollars on Chinese products, and Beijing has retaliated in kind. In December 2018, after months of trade hostilities, both countries have agreed to halt trade tariffs and allow for talks. So far, the United States has imposed 3 rounds of tariffs on Chinese goods, totaling more than 250 billion, with duties ranging from 10 to 25% and covering a wide range of industrial and consumer items from handbags to railway equipment. Beijing has hit back with tariffs of US dollars 110 billion on American goods, accusing the United States of the largest trade war in its economic history. China has targeted products which include chemicals, coal, and medical equipment with levies that range from 5 to 25%. The Chinese response to trade tensions with the United States has been by lowering of entry barriers for financial services and import tariffs on a wide range of consumer goods and autos, and the shortening of the negative list of foreign investments. The direct impact of the tariffs announced to date has been quite limited, but that could be amplified with further rounds of retaliation through financial and investment channels. Amongst the major opening up measures are plans to open up the financial services to foreign investment, including the rise of foreign ownership cap to 51% and removing the cap in 3 years. Manufacturing sector has been comprehensively opened to foreign competitors, and import tariffs have been cut from 17.3% to 7.7% on a selection of consumer goods such as food, health products, medicines, clothes, and shoes. Currency is the flashpoint of the United States and China's trade war. The United States says that China unfairly keeps its currency low to help boost its exports. Beijing says that it's trying its best to keep the yuan stable. The Chinese currency does not work like other global currencies which are freely traded. China is the only economy with a currency policy consistent with a reference rate policy. The People's Bank of China sets the reference rate as a guiding point, and the Chinese yuan has dropped to a decadal low and is trading at 7 yuan per dollar. The last time the US dollar traded at 7 yuan was around the 2008 global financial crisis. The American president, during his campaign, had lashed out at China for manipulating the exchange rate to boost Chinese exports and presented the issue of trade deficit with China as one of his major policy adjustments. There has been a broad consensus amongst Chinese policymakers and implementers, external experts and regulators that China should move towards a flexible exchange rate sooner rather than later. It is expected that the yuan will weaken below 7 per US dollar within the next 6 months. The weak yuan raises concerns of capital outflow risks as it loses the yield advantage over the dollar rates. That said, capital outflows have remained modest in 2018. Currently, Chinese 3-month yields are 11 basis points below the United States yields, a sharp downturn from being 250 basis points higher in early 2018. China's stated policy has been to stabilize the market expectations, and the yuan depreciation is viewed as a comprehensive monetary easing. The International Monetary Fund has said that the renminbi remains broadly in line with the fundamentals. The IMF has also said, with 3.1 trillion foreign exchange reserves, China is in a position to allow for a gradual transition to a floating exchange rate. Further, the IMF has said that the levies of reserves range between 100 to 260% of import cover. Let me also explain China's progression to a market-based exchange rate policy. In January 1994, China introduced a market-based, unified and managed floating exchange rate system. Under the new system, central banks were authorized to sell and purchase foreign exchange. In 1996, the renminbi became convertible for current account transactions. In the interbank market, the People's Bank of China limited the daily movement of the renminbi against major currencies to plus minus 0.3% around the daily announced reference rate. For capital transactions, however, exchange controls were applicable. Full renminbi convertibility was a stated goal, and it was to be achieved through a gradual and deliberate approach. The reform of the exchange rate was to be carried out in tandem with reform of state-owned enterprises, clearance of non-performing assets, and conversion of state-owned commercial bank operational mechanisms. China also pursued a gradual approach to capital account liberalization given the weaknesses in the financial system. In 2005, China moved to a managed floating exchange rate regime based on market supply and demand and with reference to a basket of currencies. The Chinese government took measures to cultivate and develop foreign exchange markets. Hedging instruments like forward and swap were developed. Enterprises were given incentives to retain more foreign exchange, and some relaxations in capital account restrictions were given. The RMB exchange rate moved in both directions against the US dollar. China's response to the global financial crisis was quick, determined, and effective. The response included an extraordinary credit expansion and a repegging of the renminbi to the US dollar. The reserve accumulation was rapid and reached over US dollars 40 billion per month. This enabled further reform of the renminbi exchange rate regime, and in 2010, the People's Bank of China announced a return to the managed float exchange rate regime. By 2011, China had become the world's central trader with the capacity to transmit and originate shocks. Currency appreciation was important to the process of rebalancing. A failure to rebalance the growth model would imply an unprecedented increase in the export market share. China launched a number of policies like Going Global, One Belt, One Road, RMB internationalization, and Made in China 2025 to provide an impetus to capital flows. The People's Bank of China announced the renminbi US dollar central parity fixing mechanism in 2015. Under the new mechanism, banks were asked to submit quotes that took account of the closing spot rate of the previous day, as also the market supply and demand. The PBC's announcement explained that the change was designed to increase the role of market forces with the policy objective of gradually increasing the exchange rate flexibility. The China Foreign Exchange Trade System announced the CNY central parity rate on the interbank foreign exchange market as US dollars per CNY at 6.7623 and the euro to CNY at 7.64 on February 15, 2019. The People's Bank of China has long argued that the price stability was a primary objective of their monetary policy. The market-based system needed time to develop, and dropping the benchmark rates would be done in a gradual and orderly manner. An explanation for the central parity system was the stated need to best reflect macroeconomic fundamentals. There were fears that market forces could create major distortions, resulting in a buildup of financial stability risks associated with capital outflows. The Monetary Policy Statement of April 12, 2019 says that the PBC will use a combination of monetary policy instruments to keep the RMB exchange rate generally stable at an adaptive and equilibrium level and strike a balance amongst the interest rates, exchange rates, and the country's balance of payments, facilitate the stable and sound development of the economy. The IMF has assessed that risks are tilted to the downside as growth could be stronger and reforms can enhance productivity and improve private sector dynamism. The key near-term risks included credit risks in the financial market, escalating trade tensions, and resume pressure on capital flows. Large capital outflows and pressures on the exchange rate system could resume due to tighter and more volatile global conditions, especially a surging dollar. Investor sentiment towards emerging markets has weakened, and this could potentially spread to China. We can say that the Chinese monetary policy is becoming more market-based, and the new interest rate corridor is the main instrument of monetary policy. There is a significant pass-through of the PBC's interest rates to bank lending rates, government yields, and other market funding or loan rates. The PBC has largely phased out regular interventions in the foreign exchange market, and the renminbi has become more flexible. Turning to capital account liberalization, it needs to be said that China's net capital outflows have declined to US dollars 82 billion in 2017, down from the record highs of US dollars 647 billion in 2015 and US dollars 646 billion in 2016. FDI inflows have remained stable. China's capital account remains relatively closed in a de jure sense, as there is an increase in enforcement measures to reduce the capital outflow pressure. The opening up of the capital account is likely to create a substantially larger two-way gross flows. Hence, the The sequence of capital control loosening consistent with exchange rate flexibility and domestic financial stability has to be carefully calibrated. China's long-term goal on capital account liberalization has been one of careful opening and integration. On the macroprudential framework, China has sought to address the key issues of regulation and supervision, credit growth, implicit government guarantees, along with transparency and improved communication. Turning to banking sector reforms, China currently has one of the largest banking sectors in the world at 310% of its GDP. The sharp growth in banking sector in recent years reflects the rise of credit in the Chinese economy. Private sector debt has risen to 175% of GDP. There are growing risks of significant stock of bad assets with overcapacity companies and underperforming state-owned enterprises. The Chinese authorities place banking sector reform at the center of their overall policy agenda. The banking sector reforms necessitated were recapitalization and restructuring of the Bank of China, the China Construction Bank, and the Industrial and Commercial Bank of China. The other steps in banking reform included development and monitoring of time-bound restructuring plans, adoption of a commercial focus, and enhancements to the market infrastructure. China has strengthened the bank balance sheets, internal control systems, and credit risk management practices in state banks. As Chinese government provided financial support to restore capital adequacy and full provisioning for the non-performing loans, the operating profits of the Bank of China and the China Construction Bank have improved significantly. China allowed for foreign ownership of banks, with the Bank of America and the HSBC procuring stakes in Industrial and Commercial Bank of China and the Bank of Communications. The CBRC took steps to monitor large exposures, undertake on-site examinations, and introduced a deposit insurance scheme. China also focused on the activities of the Agriculture Bank of China and the regional credit cooperatives. Given the huge scale of operations and exposure to the agriculture sector, restructuring of the Agriculture Bank of China and the regional credit cooperatives was also pursued. Turning to financial sector reforms, China's policy for financial sector has been to open up sooner rather than later, and a timetable for implementation of 11 specific measures has been announced. Under this strategy, China has sought to invite more and more institutional investors to invest in China's financial markets, central banks, asset management companies, and pension funds. The aim has been to open up in an orderly manner to enable convenient and effective asset allocation by both foreign and domestic investors. Foreign financial institutions have improved market access. Several American firms like American Express have created joint ventures. Standard & Poor's has been given a credit rating license, and the UBS has increased its stake in UBS Securities to a controlling share of 51%. China has also been working to expand the access to the onshore bond, stock, and derivative markets in line with international standards. There have been greater efforts for increased openness, stronger competitiveness, and greater influence of Chinese financial markets as being international markets. China has made efforts for prevention of financial risks by reforming the financial regulatory system. The mandate of the PBC and the State Council for Financial Stability and Development Committee have been enhanced. Shadow banking practices have been regulated and the irregular and unlawful activities in financial banks controlled. Macroprudential regulation has been improved along with the development of the financial market infrastructure. The Financial System Stability Assessment of the International Monetary Fund, conducted in 2011 and 17, underscored the importance of careful sequencing of financial sector reforms to be undertaken given the interconnectedness between the reform processes. The 5 major areas covered by the FSAP included exchange rate flexibility, monetary policy framework, improvements in regulation and supervision, financial market development, interest rate liberalization, and capital account liberalization. There remain serious concerns of the growing mountain of debt and shadow banking practices and the massive stock market swings. Turning to renminbi internationalization, following 2011, China facilitated a gradual increase in the international use of the renminbi. This was done by deepening bilateral monetary cooperation with 28 bilateral currency swap agreements, steadily developing offshore RMB markets and RMB clearing banks in 14 countries and regions. There has been a buildup of RMB deposits in the Hong Kong Special Administrative Region and an increase in the issuance of renminbi denominated dim sum bonds. There has also been a relaxation of capital controls to allow the return of offshore renminbi to mainland China. The expansion of the use of the international use of the RMB has occurred largely in the Hong Kong SAR region, which has an open capital account, a highly regarded legal system, and strong regulatory oversight provided by the Hong Kong Monetary Authority. The Bank of China acts as the clearing bank, and a payment infrastructure has been created. Sales of renminbi financial products were also conducted in London as part of the plans to expand the offshore renminbi business and to other financial centers. The RMB was officially included in the SDR currency basket on October 1, 2016. The Chinese authorities felt that it's a significant milestone in the process of RMB internationalization and an acknowledgement of the progress in China's economic development, reform, and opening up. China published its foreign reserves, balance of international payments, and international investment positions in US dollars and SDR terms, and has issued SDR denominated bonds in China. From 2016, the renminbi joined the US dollar, euro, yen, and the British pound in the SDR basket. It was the first time a currency was added to the SDR basket since the euro replaced the French franc and the Deutschmark in 1999. The criteria for inclusion in the SDR being the export criterion and the freely usable criterion, both of which were fulfilled by the renminbi. The renminbi's inclusion represented an important milestone for integration of the Chinese economy into the global financial system. It also reflected China's expanding role in global trade and the substantial increase in the international use and trading of the renminbi. Several benefits to the international monetary system arose from the internationalization of the RMB. The internationalization of the RMB necessitated China had to put in place a reliable rule of law, strong and credible institutions, and achieved a certain degree of openness in the capital account. On December 22, 2017, the monetary authorities of Japan and China approved allowing Japanese corporations to issue RMB-based bonds, the Panda bonds in China. That said, Japan has remained reluctant to join the RMB internationalization and is yet to sign any of the initiatives advanced by the RMB internationalization. It can be said that Japan remains lukewarm to RMB internationalization efforts. Despite China's efforts for RMB internationalization, the dollar will remain the predominant global reserve currency. The structure of the political and legal institutions and the limited financial market development make it difficult for the RMB to become a major reserve asset. Despite China's efforts, RMB use in international transactions fell by about 30% in recent years. To conclude, it can be said that China has actively pursued renminbi internationalization and has tried to position itself as an alternative to the US dollar as the predominant currency for Asia. China has also made bilateral efforts for increasing the use of RMB through swap agreements with RMB offshore markets and clearing banks in key financial centers. The importance of the renminbi in international transactions has included with its inclusion in the SDR currency basket. There has been rapid and aggressive promotion of RMB internationalization. That said, as has been cited by several leading scholars, it can be concluded at this stage that no other international currency compete at present with the dollar and euro. The enhanced international role of the renminbi is a live future possibility. On this occasion, I would like to thank Commodore Vasan and all senior members of the C3S for giving me an opportunity to present my research work at this conference. I am very happy that the Indian Council of World Affairs and the C3S are collaborating to take forward the China research studies in India. I wish the event all success. Jai Hind.